The world's greatest geologist is on the verge of his next billion-dollar discovery. With looming shortages in copper, zinc, gold, and silver, this may be the best opportunity hard asset investors have ever faced. Learn more at futuremoneytrends.com/hardassets.
Hello everyone and welcome into crushthestreet.com. We got a special interview today because we're interviewing someone on our team, and some of you know about him. His name is Joshua Enomoto, and he's our chief trading strategist at crushthestreet.com, and he's also a major contributor to our premium service, the 10-bagger letter. And I wanted to bring him on because he's got a wealth of knowledge, and he considers himself a technical trader. He's got a lot of understanding when it comes to technical analysis, but also fundamental analysis as well. I mean, after we have our conversation, you'll know that he's got a great understanding of the economy, and he's just a thought leader and one of the best that's out there today. So I'm excited to talk with him today. Josh, thanks for coming on with me.
Yeah, thanks for having me.
Josh, let's start off with the economy. Obviously, the economy is what's on everyone's mind, and more so what's going on with people's money, and that's like the markets, the stock market. What's your current assessment on the current economy and how that relates to the stock market at the moment?
You know, it's absolute madness. We just had one of the worst jobs report performances recently. Last week, when the U.S. Department of Labor, they released the results for September. Basically, the jobs that we had gained within the economy was only 70% of what was forecasted by the mainstream consensus amongst the analysts and other economic researchers. And not only that, I mean, that's bad enough when you're behind 30% against the forecast. But other than that, there's also the issue of the negative revisions that occurred for the jobs report for the month of August and for the month of July. So you have 2 months now that have seen negative revisions, and so that brings down drastically the aggregate total of jobs that are being created per month in the economy. So that pretty much brought down the average monthly jobs rate to about 170,000 jobs being created. And this is down significantly from the 200,000 jobs that were created throughout 2014 and throughout 2015 up until the last 3 months that have really started to show fundamental cracks within the economic infrastructure.
Josh, real quick, you bring up an interesting point about forecasts and projections, and I gotta ask you a question. And maybe you know, or maybe you don't. Why is it that they make these forecasts and the stock market reacts based on what the forecast was, whether they exceeded it or they underestimated it? The market reacts based on a forecast that is otherwise arbitrary in terms of good or bad. It's this, it was below forecast, so the stocks go down, or it's above, so stocks rally. Like, what's the dynamic of the forecasts when it comes to the markets?
Well, I think really the danger right now is that the dynamics are so unpredictable, and they're based on speculation on what could occur. I mean, when we had the absolutely terrible, dismal report, the dismal figures that we saw last week, the markets actually started to move higher, and they've been moving higher for the last 3 or 4 sessions. I mean, pretty big, robust moves. And I think that's, people would look at that and say, well, that's really strange. Why are the equity markets moving higher when clearly the jobs report is so pessimistic? Well, the reason why is that these traders, these hedge fund managers, they're anticipating now that Janet Yellen is going to keep the interest rates artificially lowered, and that she's not going to go through with the promised interest rate hikes. So essentially now we're going back again into that weird dynamic where bad news within the economy is actually good news for the markets, because now the traders and speculators are saying, well, we're not going to have the interest rate hike. We're going to continue to get easy credit, easy money, and that is going to lift the equity markets. But I think the real danger in believing in this speculation is I think we've witnessed a crack also within this crazy speculative equity markets, because right now we're in a major consolidation pattern within the equity indices, the Dow Jones, the S&P 500, the NASDAQ Composite. We're going up and down, up and down, up and down in this really choppy manner, but we're still being stymied by the 50-day moving average amongst the three major indices. And that demonstrates that the traders just are not, the bullish traders, the long hands of the markets, they're just not getting enough momentum. They're not, their efforts, I mean, they're pumping as much as they can into this market, but the market is simply not reacting as it should. And in the past, when bad news really was good news, we saw some massive leaps in the equities markets, and we coincidentally also saw some major declines in the commodities markets. But now I think that situation is starting to crack as well. I mean, we're not getting the kind of optimism that we would usually see when the majority of the investment community are anticipating a continued artificially lowered interest rate environment.
So, Josh, you talked about some of the fundamentals, the jobs, why the economy, what we're seeing in the economy, and you alluded to some of the technical stuff as far as the markets consolidating, but you've recently written about major markets seeing the death cross. And
Yes.
maybe you can kind of explain this to people. Some people, it's difficult for them to understand technical analysis, but maybe you can just briefly explain it and why this is important for what's really going on out there, and why this is important for people's portfolios. Absolutely.
The death cross and other technical analysis indicators, it kind of sounds a lot like voodoo. When the layman that first encounters it, it just sounds like a bunch of mumbo jumbo. But in reality, the death cross, even though it sounds like a very has a very ominous name, what it really is from a very simple technical matter is a condition when the 50-day moving average of a particular stock or asset crosses underneath the longer-term 200-day moving average. So, it's just really a crossover. Whenever you see the 50 DMA cross underneath the 200 DMA, that is considered a death cross. But the reason why people should pay attention to the death cross is because it indicates a sentiment shift. And especially when you look at the U.S. markets, the Dow Jones, the S&P 500, I argued that the death cross that we see in the Dow is very significant, because for years and years and years, we've been having this artificially pumped equities bull market. And finally now we're starting to see the first signs that this the circus that we've been parading in the markets is finally is starting to roll over a little bit. And I'm also arguing not just that the death cross occurred, but that since that death cross flashed in early August of this year, the long hands of the markets have not produced a sustained bull run that would suggest to challenge and to reverse this sudden bearishness. I mean, yes, we've had a robust move in the markets, but it's always been followed by these sharp declines. So over the last 2 months, we've had lots of ups and lots of downs, lots of ups, lots of downs, and we're kind of like not getting anywhere. And the fact that we're not getting anywhere, this is considered a consolidation pattern where the bulls and the bears are not making much progress. It's kind of like World War I trench warfare, where each side is just killing each other, but in terms of territorial gains, they're not really netting anything. And that's the same danger, the same circumstance that we're seeing in the markets. And typically, after a consolidation period, after a major decline, usually that signals a continuation pattern, meaning that once the consolidation works itself out, it usually the downward trajectory continues. What's troubling is not only are we seeing this death cross pattern appear in the Dow Jones, but we're seeing it appear in every single market. I mean, you're seeing the same the death cross pattern and followed by a consolidation pattern occur in the German markets, in the British markets, in the Asian markets. I mean, there's pretty much no market, whether you're talking about developed nations or developing nations, you're seeing the same thing, and you're not seeing any one particular market say, "Hey, I'm not flashing a death cross. Our markets are good." Nobody is saying that there's no international index out there that really shows some kind of reason for optimism. So we're all seeing the very same signs universally. We're seeing the death cross followed by a nasty consolidation pattern where there's no net gains being made. And typically, that also suggests that in the investment community, they're waiting for some kind of major fundamental sign to determine whether the markets will go higher or whether it will go lower. And I just don't see it. I mean, I would love for the mainstream media to come over here and give me some evidence, give me some facts, give me some figures to suggest that the fundamentals are positive. We just don't see it. And every news that we've been getting, fundamentally, they all point towards negativity. So this is really, I think we are headed towards one of the most unprecedented moments in market history. I know it sounds like I'm just blowing smoke, but really, I mean, I'm literally looking at all kinds of international indices. I just don't find a place where someone can go long and make money.
So is it just like a bubble economy that has ballooned and then the air is going to be let out? Is this like what it's suggesting in kind of the ultimate end game for the stock market for the next couple years? Is this what you're suggesting?
Yeah, I think it's one of those bubbles that was just slowly, blowing, higher and higher and higher. It wasn't one of those extreme like tech bubble type of situations. This is a bubble that's been brewing slowly and steadily for quite some time, and finally we're starting to see those initial signs where this bubble just simply it just can't be sustained. And I think the one of the major catalysts for a continued bear market in the future is in China and the emerging markets. I mean, China, up until June, they were doing great. I mean, everybody was talking about China and how phenomenal their stock market was. And then after mid-June, everybody was talking about how ugly their markets were. I mean, it was just a complete sentiment shift. I mean, and there's also nothing in the Chinese economy that would suggest that that there's going to be a recovery that's imminent. I mean, you see a bunch of Chinese skyscrapers that are just empty. We see entire towns. They've built up this real estate complex, but it's deserted. It's a complete ghost town. And here's another thing. India, I mean, people have this love affair with India, as they should, because of the growth that they have given Western investors. But now even India, their markets are starting to roll over. I mean, back in 2014, last year, when the Prime Minister Modi was elected, the Indian markets just skyrocketed, and people really love Modi. The Indians love him, and I think he's like a 90% approval rating. And even today, he's still, it's still a very, very high approval rating. But that approval rating, I believe, is going to drop because just recently, I think about 2 weeks ago, the Indian Central Bank announced that they were going to artificially suppress interest rates with a magnitude that was much higher than was anticipated by economists. And so what this is saying is that the Indian markets have no choice but to artificially inflate their currency in order to stay competitive and in order to provide the growth that Western investors have been accustomed to. But really, their markets have not really have not been buoyed as much by the interest rate announcement. So I think that we're headed towards a panic, but it's sort of like a slow panic. I mean, the news is not really filtering in just quite yet towards the Wall Street mainstream investors, but eventually it will. I mean, you can't lie about the fundamentals for that long.
I think people and leaders around the world lie just long enough for them to get themselves out of office, as long as it doesn't crash on their watch. And I think that's the problem with the global system. Everyone is just trying to do what's best for the short term rather than take the pain and do what's right or fundamentally right for the long term. And that's where we deal with all these problems and everyone kind of continuing this paper Ponzi scheme and artificially stimulating markets all over the place, but no one's really going to get in there and allow it to crash on their watch. And I think eventually it'll just get to the point where it happens it'll just be out of control. And so with that, Josh, what about precious metals at the moment? We've seen the last couple days precious metals see their move up. The last month has been somewhat of a consolidation period, and we're starting to see them turn around and potentially go higher at this point. Do you like precious metals at these prices at the moment?
Yeah, I think precious metals, particularly the gold market, could surprise a lot of people. I mean, I remember last year I was having a conversation with somebody that knew someone from the jewelry industry, and this individual was in the jewelry industry for, I don't know, 20 or 30 years. He spent most of his professional life within that industry, and he told my friend last year that gold was going to drop below $1,000. That his target was $700. So that if you're looking for that gold necklace to buy for your wife or something, that it would be a good time to wait for the gold price to significantly drop. And of course, we've seen the gold price. It's just been one of the worst bear market situations in recent times. However, here's the important thing. We've never crossed below that $1,000 level. I mean, we've gotten pretty close. And there's been multiple times that the bears could have driven the precious metals complex, specifically gold, below critical technical support lines at the $1,000 price point. But it hasn't happened. Even when Goldman Sachs was saying, yes, gold is going to drop below 1,000, it is going to be the worst bear market in the world. It's been terrible. It's been terrible, but it's still above $1,000. And what's interesting, I'm looking at the chart of the of the gold bullion price, the spot price. And yes, it's in consolidation, but the critical difference between the consolidation that you see in gold and the consolidation patterns that you see in the international equity markets is that this is a rising consolidation pattern. You see a formation of higher lows. And I think that's very significant because that suggests that there is bullish momentum that is buoying the gold price. And because of that, we're starting to see the narrowing of consolidation. But in this case, in gold's case, and I think any technical analyst would agree with me, at least the technical analysts that are not biased against gold, I think that this could be, this is very bullish actually. When you just look at it from a pure technical perspective, we're seeing a narrowing consolidation, but this is a consolidation that is rising, and is showing that even on the downswings are losing the magnitude of bearishness, and I think that, of course, is bullish long term. So yes, at these prices, I think that gold could be a very good buy. I keep saying could be because the dynamics in the precious metals have been very, very strange, and it's I don't want to give people a very specific timetable, but in my gut feeling, I think looking at the charts and looking at the evidence, I think that gold could surprise a lot of people, especially the mainstream.
Josh, so in conclusion, what is your strategy in general for people to thrive in this current environment? And, of course, if people do want to get more information on Josh, visit crushthestreet.com and check out the 10-bagger letter. It's only $9.99 a month. We're giving out silver coins for people who sign up, 30-day money-back guarantee. Definitely check him out there. I mean, you can get all of his information and all the past reports that he's done. Excellent stuff. But before we end, I do want to ask you, just in general, what is your action plan, and what are you suggesting to people in an overall general sense to get through this current time?
I think right now the markets are so precarious. The equity markets, you're standing on very shaky, very unstable ground. And so I've been encouraging, through my articles on crushthestreet.com, as well as my own personal articles, personal videos, I've been telling people, you just got to be absolutely careful. You got to, pull out of, if you have too much exposure to the equity markets, you got to trim that down significantly. I mean, me personally, I have trimmed it down 100%. I don't want any part of the equity markets. Now, I'm not making it a recommendation because 100% of anything is it's usually not the way to go, or at least that's not the common recommendation. But I am very bearish towards the equity markets in general, towards these mutual funds, towards the equity ETFs. Very bearish, and I think millions of Americans just they're depending on their 401k to save them. They're depending on their 401k to sustain them for their dreams and for their retirements. I think they're making a critical mistake. You got to watch out. I mean, you're playing on a 100-foot cliff, and if you drop it, I mean, you can't save yourself. I mean, I can't stress enough how bearish these equity markets can be, and it could be sustained. This bearishness could last for a very long time. So I encourage everyone, especially the people who are punching a clock and who are depending on that 401k. You got to protect your money because it's all about opportunity cost. It's better to protect yourself now And if the markets go up 5 or 10%, all right, 5 or 10%, that could be made up. But if you lose 40, 50, 60% of your retirement portfolio in just a matter of weeks, that's the kind of pain that can't be recovered. That's the kind of pain that will require another lifetime of working to make up.
Right.
And that's really the overall message I want to spread to your viewers, to your listeners, and to the subscribers out there. You got to protect yourself. Just get out while you can, while you have something to get out with, and protect that. I mean, protect that hard-earned capital. Because I swear, if you lose 40 or 50%, the thing that people don't appreciate is that when a panic happens, there's no point in trying to get out using limit orders. And it's all about market orders, because that sell-off is just so steep in terms of velocity. I mean, you could just boom, 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 boom. I mean, overnight, just lose 20%. And then the next day, you wake up and another 20% gone. I want to avoid that nightmare, because we've already seen that nightmare happen in 2008. And I just want to help people avoid making that same mistake.
Well, there you have it, everyone. That's Joshua Enomoto. He's our chief trading strategist at crushthestreet.com. Check him out. Check out the 10-bagger letter. He puts out some great informative reports and some actionable trading investment ideas that you definitely can be a part of. And like I said, we're offering a silver coin for all new subscribers, risk-free 30-day money-back guarantee. Check it out. I know you will be absolutely happy with your decision, and we'd love to have you as part of our team. So Josh, thank you so much for taking the time with me.
Sure, thanks again.